Welcome to the Mortgage 101 podcast with Anthony and Manley.
Welcome back to the Mortgage 101 podcast with Anthony and Manley, the show that helps you cut through the noise, understand the process, move forward with confidence in any market. Let's get into it. Welcome, everyone. Step right up to the American Financial Circus, the daring dance of the Fed, Wall Street, and you, the homebuyer. Who's secure? Who's running the show? And who's barely hanging on? Spoiler alert, one has a golden parachute, one has all the control, and the other, well, they're on their own. Today, we're revealing the risky privatization of Fannie and Freddie, the disappearance of QE, and how tariffs impact your wallet, and if the American manufacturing can stabilize the balancing act. Buckle up for the truth and clarity that Wall Street won't offer, but we absolutely will. You're listening to the Mortgage 101 podcast. Let's dive right in. Welcome to the Mortgage 101 podcast with Anthony and Manley. Today we're going to talk about the truth that Wall Street won't tell you about.
Step right up, because today we are entering the Great American Financial Circus. The Fed, Wall Street, and yes, you, the home buyer. We are all on a high wire.
One of you has a safety net, one of you is trying to run the show, and one of you is hanging on for dear life. You tell us which one's which.
I mean, in this episode, we're going to pull back the curtain on privatizing Fannie and Freddie, the disappearance of QE, how global tariffs are affecting our wallet, and in the end, is the American manufacturing comeback really happening?
Sounds like fun today. Hey, first topic is the dangerous push to privatization, can barely speak there, of Fannie and Freddie. Hey, that's what we're going to talk about.
Yeah, let's open up the show with what's really going on, what's really at stake here, which is the renowned push to privatize Fannie and Freddie Mac.
Hey, back in 2008, the government, when the crash crisis was happening, they privatized Fannie and Freddie, and they said it was a temporary fix. What's the date today, Anthony? I think it's 2025. We're somewhere at the beginning of June. Something went haywire if they haven't put it back to privatization since then. So it's taken a lot. That whole project of taking that into the government under conservatorship has actually brought in $300 billion worth of income to the United States, to our bottom line. And guess what? There was a clause in there that none of that money that was earned through that process went to repaying the debt that was created by turning this into a government entity. Tell me what's going on with that.
Yeah, I mean, here's the thing. The bottom line is the American people want to know what happens if Fannie and Freddie, the central bank, actually get privatized and get pulled from the government and put in the private sector. Okay, so basically it goes from the government entity to Wall Street. Well, at the end, Wall Street gets a cash cow, but what do everyday buyers and Americans get? We're going to get higher rates. We're going to get tighter loan access. We're going to get more fees and less transparency, because now it's on the private sector. It's the Wild West, so to speak. It's not going to have the government oversight. So sometimes I know, big government is not a mantra that a lot of people like. But in this case, just imagine if this 300 billion cash cow stops going to the bottom line of the US government and starts going to Wall Street. And so that's where I think people need to have a pause to say, does this make sense? Should we strip this from the government and put it into the private sector? Because who's it really helping? It's going to be helping the billionaires. It really is. It's not going to be helping the
it's not helping the buyers, Anthony. It's helping the billionaires. And at the end of the day, it's not helping the U.S. government and their whole, promise to back all this stuff, because they will eventually not back it. And it's going to make interest rates higher for everybody, because it's going to be a higher risk if there is no government backing by it all. So, hey, on my book, this is not a good idea. Typically, that's not what I'm saying. I'm not a big government guy. I'm not trying to get political, but this doesn't make any sense on my book.
Yeah, you marked it right. This is not a political statement by you and me. This is a, this is a pragmatical state. It's like the government loses control. They lose control. They lose a tool to stabilize the markets and support affordability. I mean, this means more volatility, less control, and bigger cash cow going to privatize, billionaires and hedge funds, and not going towards the bottom line of the debt that America is in currently. So I think privatization is not a good look. And I think it's going to be hard to take it from the cold hands of the U.S. government, but we'll see, huh?
We'll see. One thing you said in there, which takes us on to our next subject, is we'll lose a massive tool that we have that we use during quantitative easing. And we are not in quantitative easing. We are now in quantitative tightening to try to bring that back. So that might be interesting to you. But the question is, will we see that quantitative easing again in the near future, in the next 12 months, in the next 24 months? Take a stab at that for me. Tell me what you think.
Yeah. So for our listeners, you got QE and you got QT. QE is quantitative easing. QT is quantitative tightening. It's a tool that the government uses to balance the books. What do we mean by that? Well, quantitative easing is a layman's terms printing of money, stimulating the economy, buying mortgage-backed securities. Whereas QT, quantitative tightening, is when we're not stimulating the economy. The government is actually offloading mortgage-backed securities and lessening that debt threshold. So basically, if you're saying that over the next 36 months, the feds are touting that they're not going to do QE or printing of money or quantitative easing, and they're only going to be QT, quantitative tightening, we're on our own. There is no backstop. There's no cushion. There's no rabbit in the hat, meaning we cannot use that as a tool to try to lower these rates. Yes, it's worked in the past, and that's what they did during COVID. They injected so much money into the market that it artificially lowered the rates to stimulate the economy, to really incentivize people to purchase and to borrow money. We can't do that any longer because that's not helping inflation. That's not helping the economy. So people thinking that the government, including myself, up until I would say about a month ago, I was hopeful that the government was going to start QE back up or quantitative easing once they saw that the jobs report was, looking to be unemployment ticking up. Maybe the spending was going down. And I do believe that this administration bit off more than they can chew in that they overpromised and underdelivered, not by design, but just by opening up the toolbox going, oh, wow, this is actually a long game, not a short game. And we can't just cut this deficit. We're going to have to work hard, and it's going to take years, not months. And, right now we have a short-term issue, which is rates are high. But in order to fix this short-term issue, we have to have long-term stuff put in place, which means this short-term issue is going to turn into a long-term issue.
So basically, all that in a nutshell is we're probably not going to see interest rates in the 5% anytime soon. It's probably going to take longer than anybody's anticipating, no matter what anybody says out there. We're probably going to range in this, mid sixes to low sevens, maybe a smidge over 7, depending on what happens. And we're going to need some big movement across the board in the stock market in a negative way that would bring us to the point where we actually could see rates being reduced. If they go and reduce prime rate 1 or 2 times, which everybody's anticipating happening, in this fiscal year, 2025, we will have some opportunity to see rates reduce slightly. And we're back in this whole thing that I've been saying for a long time. We're in a grind down mode. We're not going to see anything quick. We might see quick spikes up, but we're probably not going to see big jumps down. It's going to grind down. That's basically where we're going. And so there's your tightrope, Anthony. We're walking this fine line to balance the QE versus QT. And QT right now is saying that, hey, we're going to sell back all those bonds because we bought, $1.4 trillion in bonds during COVID to help bring down interest rates and get the housing market going. Because at the end of the day, the housing market itself makes up 14% of our gross, income that we make for the whole U.S. economy. That's what drives us. So we need to keep that strong and happy. That's why all these things are super important to us.
Yeah. QT is in the now and is the buzzword. The Fed's buying 1.4 trillion in mortgage-backed securities. Those days are over. they're unwinding that. They're selling off. They're reducing QT instead of QE is the mantra that the Feds are looking at. And that's keeping the rates elevated. And so they have to have a different trick, so to speak. They can't keep pulling out the same rabbit out of the hat in this circus. But the good news is there are other options that the Feds can do. There are other tools and mechanisms to get this economy back on track.
Well, let's move on to the next topic here. Let's talk about these tariffs. All this conversation a month and a half ago when the whole tariff, well, actually maybe a month ago when the whole tariff thing came out, panic throughout. We had the stock market tank. We had the bond market tank simultaneously. We've talked about it on our previous shows, why that anomaly happened that hasn't happened before, that both of those go lockstep down in the wrong direction for anybody and anybody's good. But right now the tariff news is changing on the whole, world stage. And what does it mean to us? How does this affect us, and why is it such a big topic?
I mean, tariffs on Chinese imports might sound like a political chess move, but they directly raise the cost of home cost here in the U.S. for the American consumer. I mean, we're talking about steel, lumber, windows, appliances, everything that goes into purchasing a home and creating a home. We're going to feel that, that squeeze. There's no way about it. These producers are not just going to take an L. They're not going to take a big loss and go, hey, it is what it is. It's going to be a pass through to the end user. And it's not a trickle. It's instantaneous. As soon as that cost gets pushed on them, it gets pushed on the end user. And they see that in the bottom line price. So until we see this inflation, not stay high, and until, we see these, and the other thing too with tariffs is it brings uncertainty in the market. And the market hates uncertainty. If it can't see the runway, then it's going to price in a defense because they have to. Otherwise, they'll lose their butt if they price what it currently is. But if they see some, rocky, headway in front of them, they're going to price to worst case scenario in the event that it gets there. So until we start getting our sea legs, until we start seeing a bigger runway, even though these tariffs have subsided, we got a 90-day referendum. Until things are more permanent, then we'll start to see the tariff issue go away, and we can focus on other aspects of this economy to try to fix it.
Yeah, it sounds like, we're all scared about this. We're all scared about China retaliating back and creating more tariffs backwards and getting us in this mess. But at the end of the day, we're going to find a balancing act. And this is super important because inflation's it's a sticky topic that it has an effect across the whole economy, housing especially, interest rates especially. So I think we're on a path to balancing that tightrope as well. We just got to play that balancing act and get the tariff set correctly and make everybody happy, bring these U.S. jobs back if we can, which is the goal. That's a long-term goal. Remember, this is why this is all happening for us, is we're looking at a long-term goal here and seeing what can we do to get our jobs back to the United States, get all these people working again, get manufacturing back, all these jobs that went overseas. And that's why it's a big deal. And that's why if we take it back from China, China's going to be affected. So it has to be a slow play, and a gradual play to make this all work out. So
yeah, I mean, it's a domino effect. I mean, even if demand slows and, the construction costs are still going to stay high because the inputs are inflated by the trade policy. So unless the trade policy changes, then the construction costs are going to stay high. And it doesn't matter if the demands are high or low. That cost is that cost.
Love it. Well, the long game is that the U.S. and manufacturing and trade saves housing. So let's talk about that.
Yeah, I mean, so when buyers ask, hey, are the rates still in the sevens? Sometimes the answer is in Beijing. It's not in D.C. It's 100% the tariffs. They have a big direct on it. At the end of the day, it's a whole big, stew to see what ingredients are put in, and that's going to affect the taste. And right now, the taste of rates are being affected by tariffs.
Absolutely. Still critical to keep this long-term fix in play and see if we can't balance this act out so we can get these rates to work their way down and infuse the American public with more jobs and more opportunities. All right. We're coming into the rapid fire round with our studio producer, Kevin Hansen, the great. guy that gets us all this going here with the lighting, the sound, the everything, makes us look good, makes us feel good. And now he's going to try to throw some wingdingers at us.
All right, time for this week's rapid fire buzzwords. These 8 terms every buyer needs to know. I'll call them out. Anthony and Manley, give me your one-line answer. Number 1, pre-qual versus pre-approval.
You got it, Manley?
No, you got this, buddy. I love this.
Okay.
This is you.
All right. So a pre-qual is a qualification that basically is only as good as the paper it's on, right? So you do the application, you say, I make this, and we see a credit score, and we look at a debt to income ratio. So you're qualified. You know, this is what your payment is. This is what your out of pocket is, but it's not approved. So you want to do a pre-qual to figure out what your budget is, but you want to do a pre-approval so that way when you start shopping, the agent on the other side sees that you're fully vetted, that your income, that your assets, that your credit, that your profile, everything's been vetted out, and we have the paperwork in hand. So we're not just taking your word for it. We can actually see it, vet it out, qualify it, and certify it. That is the pre-approval, which is one step shy of, a full approval or a power bid.
The pre-qualification is the back of a napkin, at the cocktail party that says, hey, if I make $50, I have $23 that I can spend on housing and debt. The ratio is, 48% of my income gets to be spent on housing and debt. That's that's a pre-qual. You just told me you made $50. I'm telling you can spend 23. I don't know anything about your credit. I don't know nothing about nothing.
Pre-qual is like I said, only as good as with the paper it's written on.
Yep. Moving on.
All right, number 2, power bid.
All right. Power bid is a product that we have that takes us beyond the normal traditional pre-approval. It takes us from the pre-approval stage to a fully underwritten loan, and it gives us the opportunity to have our buyers compete against cash buyers by waiving their financing contingencies. And we have done a fully underwritten vetting of all income, assets, and credit. The only thing we don't have is an accepted offer in our possession so that we can get an appraisal or maybe even get an appraisal waiver that matches the value of the contract. And then we can close quickly. We might even be able to close in 7 days if everything lines up. I just had a power bid that I put together last week, Thursday. We got an accepted offer on Friday. We have a appraisal waiver. We're ready to close. Unfortunately, the seller can't close until June 30th, but we could close in the next 3 days. We're done. Game over. Amazing.
Well said.
All right, number 3, loan estimate.
Loan estimate, super important for the buyers out there. You want to know what you're getting into, and you want to know the particulars. You want to know your payment, your full payment, principal, interest, taxes, insurance, mortgage insurance, HOA, a whole shebang. You also want to know the fees and the cost, the third-party fees, the prorations. You want to know exactly what you're getting into. So that way, before you even step foot in a house, you know your payment, you know you're out of pocket, you know exactly what you're getting charged for, and you are confident going into the process. That's what a loan estimate is.
Well said. Perfect.
All right, Manley, you touched on this earlier. Debt to income ratio.
All right. So we did do the little analogy for the cocktail napkin, but it's pretty simple. The amount of income that you bring in divided by the debt is going to give you what your debt to income ratio is. And we need to keep that at 49%, 48%, depending on the product. FHA, you can go a little higher than 50%, depending on VA, you can go a lot higher, but it's all dependent on the scenario and what's going on. But again, it's pretty simple. Your debt divided by your income.
All right. Next, rate buy down.
That one's a good one, and it's misconstrued a lot of times. So you have 2 different types of rate buy downs. You have a rate buy down for the entire duration of the loan. Then you have a temporary rate buy down. So the whole duration of the loan, you want to look at the break even, meaning if you have a 6.5% rate and you buy it down to 6.25, how much is it costing you upfront, and how much are you saving per month? So if it's costing you $5,000, but you're saving $100, it's going to take you 5+ years to break even. And in this market, when rates are only going down, you're probably going to refinance in under 5 years. So you're going to leave money on the table. Whereas the temporary rate buy down is the best option because there is no break even. Say you have a 6.5 rate, but then we do a temporary buy down. So the first year goes to 4.25, 2 percentage points lower. The second year goes to 5.25, 1 percentage point lower. And then it goes to 6.25 year 3 through 30, pushes all of the savings into the front of the loan. So you be able to recoup all that money in a quicker amount of time. And it doesn't matter if you refinance in 6 months or refinance in 2 years. If you refinance in 6 months and you don't use the money that the seller used to allocate that rate, it gets applied to the principal reduction at the time of the refi. So you can either refinance in 6 months or 2 years. It doesn't matter. So that way you're in control and you're not having to force to do anything.
It's a win-win product where we're waiting and hoping that these interest rates do come down. It is a temporary product, but it does do wonderful things for you to help get you in line with a lower interest rate.
All right, number 6, escrow.
All right, you guys, escrow is two terminologies. My friend Anthony in his world and a lot of stuff he does, that's what they call when they get under contract and the property is actually has an accepted offer. They put their whole thing in an escrow because they don't fund on the same day that they close. There's a waiting period for all the bills and everything to get paid during that time frame. But a typical escrow that probably what most people are talking about is escrowing property taxes and homeowners insurance. And that's a pretty simple thought process. We are going to escrow the property taxes and we're going to take the total annual payment, divide by 12, and that's going to be added to your monthly payment. And we're going to also escrow the homeowners insurance, same concept. We're going to take the total annual payment, divide by 12, and we're going to have a monthly payment that gets put into the escrow bucket. And the escrow bucket is a savings account so that those funds are available when the bills are due. And they're typically paid 30 days in advance of the due date, just to make sure there's no possibility for a lapse on the homeowner's insurance or the property taxes. Now, the interesting part is you don't have to necessarily escrow if you're putting more than 20% down, but most investors today that we work with, they actually penalize you if you don't escrow your taxes and insurance. Why would that be? Because they want to mitigate the risk of those two elements taking a toll on their mortgage. We're building a securitized product here for them. And so we want to give it as much risk mitigation as we can. Adding the escrows for the taxes and insurance helps mitigate those risks. You might see an interest rate an 1/8 to 1/4% higher if you choose not to escrow, depending on the situation.
And a fun fact, if you do an escrow with Manley, it has to be a red bucket, and it can either have flannel patterns or it can have red innuendos. That's very important for you consumers out there. Just want to put that out there.
We're working on the guarantee rate red, okay? Or excuse me, the rate red. So,
Rate red.
Rate red.
All right, next, moving on. PMI, private mortgage insurance.
PMI. I mean, I think PMI is not TMI because PMI is a twinkle in our eye. What do I mean by that? A lot of people think that PMI sucks because it's mortgage insurance. And it's like, why do I got to pay PMI? Well, if you put 20% down with a conventional, you don't have to have PMI. But the beautiful part is you don't have to put 20% down and you have mortgage insurance. So would you rather put an extra 20, 30, 40,000 down and avoid PMI, or, $60, $80, $100, $150 a month, and now you don't have to put 20% down? So it's all about math. We want to look at, you have loads of cash that you can offload to where it's going to make sense, or is that cash that you're currently having to displace paying more dividends or yield, and it's not going to make economic sense to displace it to put down on an asset? Because regardless if you put 3% down, 5% down, or 20% down, you still now own a physical asset, and the appreciation stays the same. The pay down principal stays the same. The only difference is the mortgage insurance. So our grandparents, our parents, they did not have the luxury of having mortgage insurance because back in the 70s, they had to put 20, 30, 40% down. Whereas now, Gen X and millennials, they can easily put 3% down and pay itty bitty little mortgage insurance. So mortgage insurance is your friend. I want you to embrace mortgage insurance. I want you to whisper in its ear, thank you. Don't slap it around. Don't treat it bad. Don't put it in the corner. Yeah, that's my take.
Nobody puts baby in the corner.
Nobody puts PMI in the corner.
But the one thing I'll ask you is, like, PMI is also one of these things that we can make go away pretty quick because we have all this great appreciation that's happening. So when people do PMI and they're putting 5% down, 10% down, the length of time that they're actually going to have PMI is actually not very long. So that's another thing to take into your calculation and your thought process of what is this going to cost me to avoid taking the money out of my pocket, taking it out of my savings account, taking it out of my brokerage account, and putting it forward on this type of product. So
you're speaking facts, dude. You are just speaking facts.
all right. I was about to get the blue light there. I don't know what I did, but I think I was talking too long.
Well, no. This brings up a question. So what happens between 0 and 20% that requires the insurance?
Basically, 0 to 20% is risk. The more you put down, then the less risk until 20% hits. And then the banks go, well, you got at least 20% down. We don't need to insure it because if we go belly up, we got enough equity in there. Now, fun fact with FHA, PMI, it doesn't matter if you got a 600 FICO or an 800 FICO. It doesn't matter if you put 3.5% down or 20% down. The PMI for FHA is the same across the board. But with conventional, it's all about the FICO score and it's all about how much you put down. Your mortgage insurance will be less if you put 10% down compared to 5. And it'll be less if you put 15% down compared to 10. The more you put down, the less it is until it goes away. The second thing is FICO score. If you have an 800 FICO going conventional, your mortgage insurance is like $50 a month on a $300,000 house. If you have a 650 FICO, that mama jama is like $600 a month. So it's telling you this ain't your smoke. This ain't your rodeo. You should not be in this circus. If you got a 650, you better go to FHA. So it shows you on a monetary level that it's going to hurt you on a price increase the lower your credit is.
So why would that be though? Sorry to interrupt, Kevin. Why would that be though? It is because with FHA, it's federally backed. With typical mortgage insurance, it's in the mortgage insurance is private. Takes us right back to the beginning of our conversation. If we privatized, the mortgage industry, Fannie and Freddie, this is the perfect example. The beauty of the federally backed FHA product is it's stable and stagnant. It doesn't matter what your credit score is. It matters how much your debt to income ratio is and how much you're putting down. It can be lowered, but it's still a static number. Where
Manley, I'm going to knight you right now with my back scratcher. I'm going to knight you because you actually just made a correlation in real time. So folks out there listening, that dude in the red glasses just blew our minds. He literally just showed the correlation with privatization and the effects. When Fannie and Freddie, which are currently under the federal backing, just like FHA is a federal backing, the mortgage insurance is a lot less. Okay, the oversight is less or is more. Sorry, and the cost is in line. Whereas when we go to the private sector, like mortgage insurance, private mortgage insurance, now we see it all over the place. There's like 15 different shops that we shop for to find the lowest, but they all raise it up. Just like, here on the islands, when Southwest Airlines came, the only big guy on the campus was Hawaiian Airlines. And when Southwest came, we're like, yes, we have competition. And so Southwest came and was doing super cheap flights, but then they started raising it and aligning it to where they're both the same because they realized that they're private and they're just going to get in and get people comfortable and then raise it back up to the norm. That's what you get with private because private equals money and money equals fat cows. And that's exactly what it is. So unless you're a billionaire or unless you're a monopoly or a hedge fund, you ain't going to get that juice. You're just going to get the squeeze. So at the end of the day, that's a perfect example, Manley. FHA is not privatized. Mortgage insurance is privatized. Which one is based off of a lot more levels and levers? 100% the privatized.
I'm going to go one step further with this whole concept because I'm taking it here. But why on earth would an interest rate at 15% down, the note rate at 15% down, be a better interest rate than somebody who's only putting 20% down? Because everything we just talked about means that, hey, we're mitigating risk between that 0 to 20%, which was Kevin's question. We're mitigating risk with this mortgage insurance, either it be, private mortgage insurance or FHA. But why on earth would you get a better interest rate at 15% down, 10% down than you would at 20% down? Question of the day.
Well, because it depends on what bucket of risk it goes into. That's how we got in the issue of the subprime lending back in 2008, where they were batching everything as perfect loans. Meanwhile, grandma had no job and she was about to get a balloon payment that was going to make her go belly up. So the answer is risk. The higher the credit score, the lower the risk. The lower the risk, the better the gain and the better the debt. And so there's a premium to that.
At the end of the day, they like to mitigate risk. And if you are, have an out, if something happens from a default standpoint, if you have the mortgage insurance, the end investor is going to get more money than he would if you had 20% down and they had to do the same fire sale. So you buy a $200,000 property, you have to fire sell it at 120 because the guy went belly up. If you have the mortgage insurance, you're going to get a specific amount over the top of the 120. So for the end investor and for the people that hold the note itself, they're going to do better off when there's mortgage insurance involved. So that's why statistically it swings to 25% or 30% down to get you in the same, interest rate range. That's typically the question that I get asked a lot, like, wait a second, what, that interest rate's not as good as it was at 15% down? And, I have to pay $38 a month in mortgage insurance? That doesn't make any sense to me, Manley. Well, because first off, let's keep that $50,000 in your pocket and pay the $38 because you're making more than $38 a month in interest on that $50K. But also, you're going to get a better interest rate until you put 25 to 30% down. Just, again, I took it really deep there. Sorry.
We follow the math because math doesn't lie and math is facts. That is it. And so I get that all the time of like, hey, if I put 20% down, do I get a better interest rate than 15? No, you do not. Well, that doesn't make sense. Well, the banks like that insurance policy that mitigates risk. When that insurance policy goes away, now there's more risk, even if you put 5% down. Whereas, like you said, once you put 25 or 30% down, now that goes away and you start seeing a little bit more benefits. But that gray area of 20% does not help you. It only mitigates risk to the bank.
So that's the myth buster of the day. Is 20% the best amount to put down? It is not.
15 or 25. Pick your
15
choice.
or 25. Thank you very much.
Bam.
Thank you, Anthony. All right. Back to you, Kevin. Sorry.
All right, next one.
You.
Appraisal gap.
You got this one, Anthony?
I do. Okay. Appraisal gap is not some issue that you're going to have at a sports club to try to get healthy again. All right. There's no exercise to get away with the appraisal gap. Okay. There's nothing. But what it is, it's a financial tool to say like, hey, here's the purchase price and here's the appraisal. Now, back in 2008, we did not have appraisal gap oversight, meaning the lenders were in cahoots with the appraiser. And if the lender didn't like the appraiser's outcome, the appraiser would get fired. And so the appraiser's like, well, I don't want to get fired. I still want to have business. So I guess I'll just give them what they need. And that's how we created the financial housing crisis, because appraisals kept going up until we fell off a cliff. Now,
contributed
100%.
Contributed.
Now we as lenders can't talk to the appraiser. We have what is called an AMC or an appraisal house, where we talk to the appraisal house and the appraiser house talks to the appraiser. So then that way there's a firewall and there's a band of a void that we cannot talk anything about the appraisal. So what does that do? It lets the appraiser be independent of the contract and give his non-biased opinion. And so a lot of times, especially when the markets swing up and swing down, we will see a difference in the purchase price and the appraisal price. So if the purchase price is say $250,000 and the appraisal price comes in at $240,000, that's a $10,000 appraisal gap. That's where negotiations come in for the buyers and sellers to go, well, I don't want to pay over appraised value. But then the seller's like, well, there's 5 people who want this house. I'm pretty sure I have a good odds that someone's going to pay it over. And that's where negotiations, that's where if it's a buyer's or seller's market, and that's where it comes in. So the appraisal gap is real. It's not something that any exercise can get rid of, but it is something that your lender can advise you, and more importantly, your realtor can set you up for. When your realtor goes out there and you put an offer, they don't just turn a door. I know it's crazy. Realtors, they get a bad rap because they're just door openers, but I promise you the good ones are not just door openers. They close the door as well.
Realtors. Mine are all the best. Not one of them's a door opener.
Yeah. No, what they do is they do research. They're looking at that house to say, in this area, what are comparables? What are like kind? What is this market like? Is it ascending? Is it descending? All these items, and they can see, okay, this house is $250,000. If that realtor is worth their weight in gold, they're going to look and go, what is sold in that area? They're going to be able to see with their MLS and comps, wait a minute, this is the highest priced house, and I don't see anything that's sold that high. That's when they're going to go, if they're worth their weight in gold, to the seller's agent and go, hey, Mr. Seller's Agent, I can see you guys want top dollar on this. I'm just letting you know if it comes in under, your sellers want wheeling and dealing. If they go, nope, they want that price, that realtor is going to go to that buyer or you and go, listen, I looked up the comps and they're not here. We may have an appraisal gap. I'm just letting you know they're not budging. So unless you plan on spending 10, 15,000 over, this may happen. That's when you, the buyer, is now educated to go, I really want this house. It's in my school zone, has the pool, has everything I need. I'll make it up. I'm prepared. Or you're going to go, nope, I don't want this smoke. I want something else. That's what the appraisal gap is. Make sure that whoever agent you're working with, when you put an offer on a house, you know the numbers behind it, and you're not just doing a blind offer and then sabotaging the deal halfway in it.
Yep. There's a lot deeper to that can be thought and talked through, that the appraisal gap itself, you can put an appraisal gap policy in your offer and say, hey, I'm willing to take that $10,000 possibly or $15,000, appraisal gap swing because I really want this property. But recognizing, and you talked a little bit about it, that the market, and we're in a fast moving market, and values are going up, purchase prices are going up as we speak because of the competition, because we're having multiple offers coming in. So it's winding it up. The poor appraiser gets a bad rap at times because he's stuck with a very specific set of parameters that he gets to use to build his appraisal. He has to find comparables that have been sold, actually sold and recorded in the last 6 months within that area, like close by. So the problem is, in the market that we're in right now, it is possible that the actual purchase price could be outpacing what's happening from an appraisal standpoint. So then what do? Then you have to have that real conversation again with your buyer and say, hey, Mr. Buyer, we see that you're doing a high bid over ask, and we have this tool that we can provide you to show the appreciation and how quickly you're going to make up that $10,000 gap that you might have created. And it might happen within 2 months just because the market itself is going to catch up to the appraisals. So that's important to understand. Good loan officer is going to take you all the way through that, give you the ups and downs of what they think the value is. Your realtor is going to walk through it with you, show you what they think the values are. And then you're going to have that heart to heart with yourself. And if you can set your ego aside and say, hey, look, 6 months from now, this supposed appraisal gap that was created is not there anymore. We're out.
Yeah. And you bring up a good point. I mean, communication is paramount in our business, especially with the realtor, especially with the buyer's agent. If the lender and the buyer's agent are not cohesive in communicating, you're going to have a fractured escrow. You're going to have a fractured process. It brings me to a gangster agent that I work with in Nevada. Her name is Monique Buchanan with EXP. She is a gangster.
One more time on that name. Big shout out to Monique.
Big shout out to Monique Buchanan. She is an icon agent. She has a lot of the market share because of how effective her communication is. This week, she did last week, because it's Monday. Last week, is it Monday?
It's Monday.
I think it's Monday. I don't know what day it is. Welcome to Lenderhood. So basically, last week, there was an escrow. The buyer wanted this house, but she was like, man, I don't see anything remotely close to this number. The selling agent was like, nope, it's going to come in. I guarantee it. Monique's like, you know what? I trust you. You are totally right. So what did she do? She put in the contract that if the escrow appraisal comes in under asking, that if the seller chooses not to proceed forward, the seller pays for the appraisal. And so,
There you go.
and
Put
so
your
they
money
put
where
it
your
in
mouth
there.
is, sunshine.
She put it in there, and the seller comes back and goes, whoa, wait a minute. Why does the seller need to pay for the appraisal if it comes in lower? And Monique's like, well, you promised me. You said you guarantee it. So there's the guarantee in paper. And she was like, yeah, I said I guarantee, but I didn't say that I would put it in writing. It's like, well, we live in a world of writing, because yes, you're guaranteed, but handshake days are over. And sure enough, she put her money where her mouth is, and the sellers agreed to it. So I thought that was pretty amazing that, she did that rather than just taking the word of the realtor. She said, okay, if there's an appraisal gap, you're paying for the cost that the buyer was supposedly going to do, which I think is brilliant.
Love that. Love that. Love the shout out. Again, we hijacked Kevin here a little bit, long-winded. Some of these things are really, they have nuances, and I think it's important that people understand what your choices are and what those nuances mean to you, because it does affect everything. And in the market we're in, these are all super important when you're out there writing offers, to understand where your position is. And I had multiple conversations just over this last weekend with realtors and buyers talking about this same subject. And, it's super important. Educate, communicate, provide information so they can make a good decision. I'm not telling somebody to just, throw willy-nilly to the wind and I'm going to just go crazy. But this is the market we're in. You cannot feel bad if you're going to, if you think you're going to get the top dollar, the best price in this market, it's not going to happen if you're the buyer. You're not going to know.
The rapid fire buzzwords are letting the buyer know enough to be dangerous, right? They know enough to be dangerous to be able to sound the alarm or be able to ask the right questions. A buyer needs to have the who, not how method. They don't need to necessarily know how to get a good mortgage or how to get a good investment. They need to know who knows how to do it, but they also need to know some things to be dangerous. And that's what these rapid fire buzzwords are. And they're so important. And yes, I know that's why it says, Kevin is like, give me just a one-liner, because he knows that we can do a whole episode on one buzzword. So
it's one buzzword. But it's important. I really, truly believe we wouldn't be doing any of our viewers and listeners a real service to gain some knowledge from what we're doing if we didn't, take this a step further on some of these. So anyway, I'll give it back to Kevin. We just rambled on.
Is he awake? Wake him up. Yeah. Kevin, you awake?
And to be fair, I derailed it myself with the other one. All right, one last one for today. Title insurance.
That's you, Manley.
Super important. It's one of these things that people look and say, what is this dumb, junk fee on my loan estimate for? I know that's a junk fee, Manley, blah, 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 blah. Well, at the end of the day, without title insurance, the whole premise behind title insurance is it's insurance. And it's insurance to make sure that you have clear title on the property that you're buying. And it insures the lender and the buyer to make sure that nobody can come back after you from a later date, from 25 years ago when they had some work done on the property and Billy Bob's ditch working company put a $150,000 lien against the property that nobody knew about because nobody did a title search. Nobody did the proper title insurance, or that the house was sold, 25 years ago and nobody paid off the actual mortgage. So there's all these things that come up, and it's the mortgage insurance in a nutshell protects the buyer and protects the lender from having some unknown, cost come back to haunt them. And it's up to the title insurance company to mitigate that risk by doing the searches and by putting the insurance policy in place. So in the event that the unfortunate thing happens where something did get skipped over years ago, then the title insurance is going to pay for it, not the homeowner and not the lender.
Yeah. I mean, to note on that, I would say it's representation. It's legal representation. And when you're going into a binding agreement from one person to another, you want to make sure that you're looking under every crack, under every corner, because like you said, when you're passing that torch from one owner to another, there could be some skeletons in the closet. You don't want to have to pay for legal representation to where when you close, I have a couple times in 20 years, there'd be some some cheapskates. I'm like, I don't want to pay the $600 for the stuff. And then I'm like, okay, that's your prerogative. And then like 3 years later, they're like, there's an encumbrance on my land and there's this and that. And I'm like, okay, well, did you call your title company and invoke your title insurance? Well, no, I saved $500. All right, well, go find a $500 an hour attorney to spend 10 hours just to figure out what's going on to start the process. And that's what it's about. Basically, these title companies have attorneys on retainer. And so it's like insurance. Insurance is to mitigate big dollar risk. You have car insurance because the chances of you getting in an accident in your lifetime are high. And so rather than having a big ticket item, you pay it in itty bitty little places. So that way you don't feel the brunt. Same with title insurance. You're buying a big asset. Pay the $1,000 or whatever it is. So that way you're not knocking on an attorney's door going, here's a $5,000 retainer. Help me figure it out.
Awesome. Thanks, guys. That is a wrap on today's rapid fire buzzword segment, your mortgage cheat sheet for this episode. Guys, what do we have for our final topic of the day?
Anthony, you're up. This is your choice, dealer's choice. I know you play poker on Saturday nights and you like to take advantage of these ladies that you play with. So let's hear what your topic of the day is so that we can go out on a good note.
Recession probability. How about that? Let's talk about the recession probability because we talk about the changing of guards with the privatization of Fannie and Freddie. We're talking about the China tariffs and the market and the outcome and the uncertainty. Let's talk about recession. I'm going to keep it kosher and I'm going to say recession is 50-50. I know some clients and some listeners wish they can hear a more factual amount of 75 or 25. But at the end of the day, it's a 50-50 coin toss because there's so many variables that are constantly changing, a lot of levers. Just think of the Wizard of Oz with the conductor behind the curtain and he's pulling and all this and every action has a reaction.
Curtain?
Oh man, it is
green.
It is green as in money is the root of all evil and the root of everything about the economy. And so, at the end of the day, you just like Manley, like you said, you have to be educated and you have to be prepared. It's not a question of if we're going to have a recession. It's when we're going to have a recession. Just like a heartbeat, it has to go up and down. Just like frequencies, it's got to go up and down. Just like our hairlines, they go up and we want them to go down. The same with economics.
Others.
Hey, you got a beautiful head. Okay. That's beautiful. But just like with the economy, there has to be a balance. So here's the thing, people who are looking at the future and they're worried about a recession, they are not living in the now. They are living in fear. Okay. And that's going to create a catatonic state of you doing nothing, which will eventually lead you into a darker place. So there's always going to be a recession and a horizon. It comes and it goes. We've had dozens of small recessions since 1932. We're going to have more in the future. Don't let the fear of recessions or don't let the fear of economic constraints dictate what you do in the now. If you are ready to buy a house, a dwelling is a needed item. You need a habitable space. Now, the question is, do you want a habitable space where you're paying a landlord and they're paying down the principal and they're getting the appreciation and they're getting the tax incentives and they're getting the cash on cash? They tell you if you can have a dog. They tell you if you can paint the walls. They tell you what school district your kids can go to. Or do you want to take control and you dictate your future? You dictate those. That's what homeownership brings. It's not just about economics. It's about aesthetics. It's about living. It's about making choices based off of what you want and not what some Joe Schmo wants when he collects his rent at the end of the month.
Thanks for that, Anthony. That was great. Again, we're just trying to come up with something positive to help educate our potential buyers out there in the marketplace, people that are interested in getting a mortgage or understanding what a mortgage means to them. And we're hoping that we're giving you some nuggets and some thought processes to think about. Remember, go find a really reputable lender to help you. Reach out to Anthony or myself. If we're in your market, we're happy to help. Appreciate all your time, Anthony. Thanks for taking us through the Great American Financial Circus that we're in today, talking that through and understanding the tightropes that we're balancing on right now. Because there are some. Are we in a bad spot? Not necessarily. But should we be watching our P's and Q's? We should. So pay attention. Don't let any of this stop you from, trying to realize the American dream of home ownership. And let's take this to another episode, to another time.
Absolutely. And the last final off is, in this Great American Financial Circus, out of the three, who has the net?
Quite sure. That's a loaded question.
The answer is the government has a net, the people don't, and Wall Street does. And so the American consumer is the one that has to really look down, whereas Wall Street and the Feds, they're only looking up because they know they got safety nets for decades, and they got policies. And so at the end of the day, this podcast is not for the billionaire. This podcast is not for the hedge fund.
Again, everybody, thank you for watching, listening, however you're catching our podcast. We hope you like it. If you do, smash that like button, subscribe if you can, pass this on to a friend that's looking, to get a mortgage, or, talking about, hey, I want to be a homeowner one day. Maybe they'll get some insight out of this and help get them off the ledge. Look for us on Instagram, on Facebook, all those social media things, and hope to see you guys again. Thanks for coming. Thanks again for stepping into the Great American Financial Circus. Remember, knowledge is your safety net. Use it wisely. Share this episode with an aspiring homeowner, investor, or anyone trying to make sense of today's financial high-wire act. Don't let them face this circus alone. Join us next week on the Mortgage 101 podcast, when we will be tackling the burning question, is this truly a buyer's market, or is it just another sleight of hand illusion? If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.